fellow South Africans. I'm addressing you this evening.
All your years of paying tax, you helped us overcome our darkest hour. You, along with every other loyal taxpayer, helped build this nation. Thank you for every life you saved and for every risk you braved, for giving our future generation a healthy start. When you saw many of our vulnerable communities, you provided for them. When you saw our healthcare workers on the front lines battling COVID, you rose to the occasion and gave them the tools to save lives. Without your tax compliance, we wouldn't be able to fight a good fight. Thank you for contributing to the important services our vulnerable communities rely on every day. To all taxpayers and traders, continue to pay your tax because it matters to millions of South Africans who depend on it. Your tax matters.
Well, good afternoon or good evening, depending on your view as to what 5 o'clock is. But thank you so much for joining us in this trust seminar today. And we look forward to engaging with you in respect of a topic that can be quite emotive. And when we think of trusts as a tax person, and I'm being one of those, you tend to think of tax avoidance or tax evasion. And that always comes to mind with the intent to do certain nefarious aspects in your estate to make sure that estate duty is not paid or whatever it might be. But as a taxman, obviously, trusts are viewed sometimes with a little bit of suspicion, but they are a vehicle that is out there and is available for taxpayers. And it's important that today we clarify our perspective in terms of many aspects of trusts. Just before I kick off with introducing a couple of things, I was quite interested to see that 218 years ago in South Africa, the first trust was registered. Now, that's quite a long time ago. And interestingly enough, in 1836, which is not far off 200 years ago, we had the first case law relating to trusts in South Africa. Obviously, it was a very different place then, and tax law and trust law has moved on considerably. So tonight, thank you for joining in a very important subject. We look forward to the engagement. And to assist in the engagement tonight, we've got two channels that you can send questions to, obviously in the Q&A that is available on the Zoom platform. And if I look now, we've got 304 people on the platform today. And then very importantly, we have an email address, and I'm not sure whether we'll flight it or not, but it's trustquestions@sars.gov.za. Let me repeat that, trustquestions, one word, @sars.gov.za. We will provide the presentation in due course on our website, and that will be available for people who would like to look at that separately. But thank you very much to you taking time out of your busy schedule to engage us here tonight. We look forward to good engagement, and we look forward to good questions. If we don't have the answer, we'll try and find the answer for you. I'm sure there will be some questions we will not have the answer for tonight, in spite of us having quite a good and illustrious panel from the SARS team here tonight. And thank you to them for their engaging with us here tonight. Thank you. I'm going to take a moment now to firstly introduce our keynote address, and it's in respect of Advocate Sam Murrigan. Now, and we're just going to flight the presentation. Advocate Sam Murrigan holds a BA, LLB, LLM, and MBL qualification and is a practicing advocate. She commenced work at SARS in 2007, holding various strategic portfolios, and is currently responsible for the end-to-end administration of trusts. Just in terms of our context at SARS, we call it a segment, so the trust segment, and she leads that, and we are busy with a number of programs that we are dealing with to enhance the service offering and obviously to ensure that we collect the right taxes. But thank you again. And with that, over to you, Sam.
Thank you, Program Director, for the warm introduction. Good afternoon to all. It's a great pleasure to deliver this keynote address. SARS' vision is to build a smart, modern SARS that is trusted and admired. And its mandate is to collect all revenues due to ensure optimal compliance with tax and customs legislation, to provide a customs service to optimize revenue, border protection, and facilitate legitimate trade. SARS delivers this mandate from the various legislation that it administers, such as the Tax Administration Act, the Income Tax Act, the VAT Act, etc. SARS exists to serve the higher purpose of enabling government to build a capable state that fosters sustainable economic growth and social development that serves the well-being of all South Africans. SARS' strategic intent is to follow the internationally recognized approach to voluntary compliance, and to achieve this, SARS has 9 clearly defined strategic objectives. These are to provide clarity and certainty, to make it easy for taxpayers and traders to comply and fulfill their obligations, to make it hard for those taxpayers and traders that do not comply, to develop a high-performing, diverse, and engaged workforce, to modernize our systems to provide digital and streamlined services, to drive effective use of our resources to deliver quality outcomes and performance excellence, to work with and through stakeholders to improve the tax administration system.
Sam, sorry to interrupt. We can't see you, just that you be aware.
Thank you.
Perfect.
And to build public trust and confidence with the tax administration system. Internally, this aspiration implies that we engage our stakeholders ethically and beyond reproach, to use technology and data to build an intelligent organization, to evolve our staffing model towards high-value knowledge and service work, and to become an employer of choice with high-performing and engaged workforce. Externally, this aspiration implies that we achieve substantially our strategic intent of voluntary compliance. We benchmark well against the best amongst our peers internationally. We regain public trust and confidence. We provide financial resources to government to deliver. The product unit that forms part of the product, process, and segment cluster exists within the enterprise strategy, enablement, and modernization division, and are responsible for the end-to-end product and segment value chain, architecture of products in their design and engineering, which is executed through modernization and maintenance in a manner that facilitates voluntary compliance. This is done to support a smart, modern SARS with unquestionable integrity, trusted and admired. The product unit has been set up to design product blueprints. The segment unit provides specialized segment knowledge in support of design blueprints, and the process unit is responsible for engineering of the design blueprints. These are driven through technology, data, and legislation. In providing clarity and certainty, we want to set an empowering and enabling taxpayer experience. Taxpayers are provided with proactive guidance and clarity as required. Taxpayers have accessible, customized support. Certain segments may receive access to leveraged products. To make it easy for taxpayers and traders to comply and fulfill their obligations, engagements by taxpayers, mainly online, intuitive, and self-managed, minimum face-to-face visits. For non-standard taxpayers, all activities in the value chain must be seamless with minimum human intervention. We want to manage tax exceptions for complex taxpayers. Intermediaries experience engagements customized with their needs. Intermediaries eventually will be enabled as authorized agents acting on SARS's behalf. We also want to make it very hard and costly for taxpayers and traders that do not comply. This involves the detection of taxpayers that negligently, deliberately, aggressively, or even criminally stay out of the tax system and do not comply. They will experience response that is appropriate to the nature and degree of their non-compliance. We will issue friendly reminders to intrusive and investigative engagements that enforce compliance or hard enforcement, court action, asset seizures, and criminal prosecution. The costs would be very high and severe. To drive the strategic objectives 1, 2, and 3 that the product unit is mandated to, we have set up a dedicated trust team to focus on trust end to end. We have recruited specialized trust skills to add to existing specialized staff complement. We've embarked on modernization of previously manual processes. We have an across the value chain focus from registration, filing, declaration, and payment. We have better quality returns, better use of third-party data, and scrutiny of nil and low value returns. We have increasing risk profiling and audit coverage. We increase in trust registrations, increase stakeholder engagements and collaboration, in particular with the MOHC, RCBs, with dedicated staff assigned for such engagement. Compliance with legal and international agreements are our focus, in particular the FATF requirements. Increased support for trust and trust initiatives has been seen both internally and externally. However, we still need to improve. Trust registration remains a concern. All trusts registered at the MOHC, whether they are inter vivos or testamentary trusts, and all CSI trusts registered at the FSCA must register with SARS and subscribe for taxes. All trusts that are registered must file their returns on time. All trusts that file the returns must make accurate declarations, and all payments must be received on time. The registration, filing, declaration, and payment obligations also applies to beneficiaries of trust. Throughout the webinar, these core themes will emerge and will be discussed by the speakers. I thank you all for listening to me. I hand back to you, Program Director.
Thank you very much, Sam, and to what you've shared with us. I think very importantly, Sam, if I may take from what you said, I think we've acknowledged that there are areas that we need to deal with in terms of our service offering for trusts where we need to improve. She indicated one being registration. So there are a number of areas, and we are committed as an organization to work on those areas to improve it as we can. Just a reminder to people with regards to the questions, which we'll endeavor to answer in the Q&A, which is on the Zoom call, as well as just the email address that we have for this evening, trustquestions@sars.gov.za. Trust questions, one word, @sars.gov.za. We're now going to move on in the presentation, and it goes into really the life cycle of the trust from registration. And with that, I'm going to hand over to one of my colleagues, Nzuka Nsita, who will take us from here. Thank you very much, Nzuka.
Thank you so much, Mark. Good evening, ladies and gentlemen. My name is Nzuka Nsita. I've got Masters in Tax, and I am a member of the trust team. My part for tonight is to take you through the requirements for to register a trust and also to clarify who is supposed to register a trust. SARS test shows that trusts, they take 2.5 years or more to register with SARS, to register with SARS after registering with the Master of the High Court. This non-compliance runs across the whole trust value chain, that is including your filing, your declarations and payments. We have noted that there's low compliance on all these 4 pillars. Therefore, our aim for tonight for coming to this platform is to educate and to cultivate a culture of voluntary compliance. From our previous webinar that was held in 2021, we noted with disbelief that there are taxpayers who do not know that a trust needs to register for tax. Now the question is, does a trust have to register for tax? My answer to that question is a resounding yes. Let's have a look at the legislation. Section 1 of the Income Tax Act defines a taxpayer as any person chargeable with a tax leviable under the Income Tax Act. Please note the word person. And also in section 1 of the Income Tax defines a person to include an insolvent estate, the estate of a deceased person, and any trust. So you can see from that a trust is a taxpayer. Section 66 of the Income Tax Act provides that the commissioner must annually provide or give public notice of persons who must submit a return. You will notice in this public notice that there is no stipulated threshold for the submission of a return by a trust. That means whether a trust is operating or not, it is required to submit a return. The reason for that, it could be that there are donations, there's loans in that trust that might have tax implications. Now, Section 22 of the TAA Act, that is Tax Administration Act, refers to a person obliged to apply or register with SARS to do so within 21 days of so becoming obliged. So now looking at these sections, you can see that the obligation to register, it stems from the requirement to file a return, that is Section 66, as I mentioned earlier, which is read together with Section 25 of the TAA Act. Currently, it is the trust that initiates the registration. However, in the near future, a trust will be automatically registered with SARS as soon as it's registered with the Master of the High Court. In the interim, though, SARS is looking at the third-party data to register all trusts that are not registered. I also just want to mention the new registrations and the improvement that we have seen from the 2021 financial year to 2023. In 2021, we had 4,000 registrations of trusts, and in 2023, we had 7,500, which is great improvement. And also want to mention that on-time registration in 2023 is sitting at 47.3%, which is quite good. But at the same time, we would like this number to increase to 100%, meaning as soon as a trust is registered with the Master of the High Court, it must be registered at SARS as well. Now, coming to clarifying who must register a trust, I'm going to define to you a representative taxpayer. Section 153, 153 of the TA Act, Tax Administration Act, defines a representative taxpayer as a person who is responsible for paying the tax liability of another as an agent, other than a withholding agent, and includes a person who is a representative taxpayer in terms of the Income Tax Act, the 4th schedule of the Income Tax Act, and Section 46 of the VAT Act. Now, for a trust, a representative taxpayer is a trustee. There is a term that we use at SARS that says main trustee We know that there are people who queried this term, saying that it's not in the legislation. We understand that, hence I'm saying this is an internal term to refer to the person who must be the representative of a trust at the point of registration. So now we also understand that trusts, they use tax practitioners to take care of their tax affairs. So today I also want to clarify what a tax practitioner can and cannot do. SARS defines a tax practitioner as a person registered with a controlling body and SARS. He or she is a person assigned with a unique identification number. Now, this is what the tax practitioner can do. Please take note that this is in accordance with the policy at SARS. A tax practitioner is not allowed to represent an entity that wants to register with SARS for the first time at the entity and product level. A tax practitioner with a valid power of attorney can only perform additional tax product registration once the first time entity and product registration has been processed. I hope that this clarification now will help a lot of people that were wondering why they are not getting any information when they're trying to follow up on the tax or registration of their trust. Thank you so much, Chair. Back to you, Mark. Over to you, Nosipho.
Thank you, Nozobo. Good afternoon, ladies and gentlemen. My name is Nosipho Khumalo. I am a BCom graduate, BCom honors graduate, and I'm part of the trust product team. I'd first like to take you through the process to register and the registration requirements for resident trusts, non-resident trusts, and collective investment schemes. Registrations for trusts can now be done in the following ways. Firstly, online on the SARS website via the SARS online query system, where you can submit the application with the required supporting documents for the registration of a trust, including the IT-77TR form. Registrations can also be done via the branch by booking an appointment. All the required trust supporting documents must be submitted during the branch visit. Should you require additional information on the required supporting documents, kindly visit the SARS website on www.sars.gov.za. I'd also like to address the issue regarding distributions to beneficiaries who are not registered at SARS. Beneficiaries of a trust may be required to declare the income that was distributed to them by the trust during the year of assessment in their income tax returns. It is therefore imperative that these beneficiaries who are required to file and are not registered for income tax register to ensure compliance in this regard. Kindly refer to the further discussion on the requirement for beneficiaries to submit a return. There are also e-filing registration enhancements for trusts. So when registering for e-filing, which would be a separate process after a trust was registered for income tax, non-resident and collective investment scheme trusts are now able to register without the mandatory Master of the High Court trust registration number, as these trusts do not register at the Master of the High Court. Then I'd also just like to explain the ways to submit a trust returns. The first one would be making use of e-filing, which is the quickest, easiest, and most convenient way to obtain an ITR 12T return. A trust must first be added as a taxpayer on e-filing, thereafter request the return, and then customize it by completing the questions on the first page of the return. Please note that any trust that has more than 10 beneficiaries at any time during the year of assessment is required to register and submit the ITR 12T via e-filing. And then the second way to submit a return would be through a SARS branch office. Trusts that are not registered for e-filing and have less than 10 beneficiaries may submit their ITR 12T returns by visiting any of the SARS branches by walk-in appointments or by voice calls or video call interactions with the SARS branch agent. Note that this process will be amended with the introduction of the IT3T. All the necessary information required to complete the ITR12T return must be collected, calculated, and consolidated prior to visiting a SARS branch. Please take note of the following. The SARS official at the branch will not assist with the interpretation of the financial statements or other information and will only capture information prepared by the taxpayer or the trust representative. An example of the trust income tax return is also available on the SARS website to assist with the information required to complete the return. SARS recommends that a taxpayer or a trust representative consult a registered tax practitioner of their choice should they require assistance in this regard. If the trust return, financial information, or other relevant material has not been prepared for capturing, the SARS agent will not be able to finalize the return. Then lastly, as part of the SARS Go Green initiative to decrease the use of paper, SARS officials at the branch will not print a copy of the ITR12T return that has been submitted. Thank you very much for listening to me. I'd like to hand over to my colleague, Michael. Over to you, Michael.
Thank you very much, Nosipho. Good afternoon, all. Ladies and gentlemen, we have quite a few things to go through this afternoon, so I'm going to try and expedite as far as possible. However, I have quite a few items that I need to discuss with you. I'm going to start with latching on to what my colleague Nozuku spoke about you. It's the requirement to register for tax and to file a return. So in terms of the annual public notice that are published in terms of Section 25 of the Tax Administration Act, and it was published last year on the 14th of June 2023. The requirement are that all trusts are required, all resident trusts are required to submit a return in terms of paragraph 2B of that specific annual public notice. In terms of 2C, it refers to non-resident trusts specifically, but bear in mind that for non-resident trusts, there are predetermined requirements that you need to meet before you have to file a return. So if you are unsure, please follow or go to the SARS website, and you will be able to access the annual public notice that are issued by the Commissioner, and there you will get the details of who are required to submit a return. Now, in that regard, it brings me to a very interesting subject, and that's the fact that we have been seeing a decline in submissions in the current year of assessment, or the prior year of assessment being 2023 in Feb. And we had to do some introspection in regards to why we were seeing a decrease in the number of returns that were being submitted. We had engagements with some of the larger financial institutions, including some of the banks, and it emanated from these discussions that some of the issues that were experienced were in terms of the new filing requirements that was introduced in the prior year of assessment, and specifically in terms of the beneficial ownership. So I'd just like to touch on beneficial ownership and just spend a few minutes on beneficial ownership. Bear in mind that beneficial ownership is not something that the trust team thought of and now decided to include it in the return. It is a worldwide initiative, and as we are all aware, we were grey listed by FATF, and we are endeavoring to get off the grey list as it opens other channels for us, for our government, and for our economy at large. So the FATF provided a significant number of requirements in terms of beneficial ownership. And as a secondary collector of beneficial ownership information, we as SARS are required to collect information. Now, you may be aware of the fact that the master in the past has not really been a collector of information in terms of the beneficial ownership information. They were merely a post box, and they collected certain information, and since 2012 a little bit more information that are available. So SARS, in fact, were sitting in a much better position to collect beneficial ownership information than the master at this stage. This might change in the future. And I also would like to mention to you that the master has now also opened up its beneficial ownership register, and that all trustees are requested to make sure that they also register at the master for beneficial ownership purposes. But nonetheless, to get back to the SARS problem. So what a beneficial owner is in relation to a trust would be in terms of the definitions provided by FATF and not by SARS. This comes from the horse's mouth, being FATF. So the details are all included in the comprehensive guide on trusts, but I will just discuss them quickly. The founder, we are all aware of. Trustees, we are all aware of. Beneficiaries of trusts, they may all be beneficial owners. And then also donors, being persons that makes donations to trust by way of a deed of donation, or in terms of the trust instrument, or any other way where they return some control. And then for the non-resident trusts, we have an additional category, which I'll not even go into now. Now, these are the main categories that we are talking about and that are required in terms of our current trust return. But it has come to light, and FATF has raised the awareness around this, that there may be other ways of influencing the affairs of a trust. So if there is another way that a trust may be influenced by way of maybe something like an inclusion of a paragraph in the trust instrument that determines that there are beneficial ownership requirements, or the right to distribute or vest amounts, or to influence the vesting of those amounts, then those individuals or entities also need to be confirmed. Now, in terms of the requirements in the current return, the founder, trustee, beneficiary, and any donors are to be mentioned, and then the protector in terms of the non-resident trusts. But for the current year, we also require you to attach a diagram or a spreadsheet indicating the different levels of beneficial ownership. So you will not be able to submit your return if you do not provide SARS with that information. Now, unfortunately, this might be to the detriment of SARS in the fact that some of the information returns were received late, or still maybe not received at this time. But we would appreciate if everybody can ensure that they try and complete the beneficial ownership information in an effort to get the returns in. Also take note that a lot of the information that is required are usually contained in the trust instrument and can be obtained there. So just that on beneficial ownership. Then I would like to move to a second section that seems to be a bit of a problem, and that is the prohibition by the Section 25 Cap B of the Income Tax Act that prohibits the distribution of a loss to a beneficiary. It is not permissible to distribute a loss except in certain circumstances where there are rules for that. I'm not going to go into that because they are very exceptional, and the entities that are involved, they do know that they qualify. That is why your return will show that it seems like you might vest a loss into beneficiaries. It is, however, in terms of the wording of Section 25 Cap B, not allowed to distribute a loss. Now, the wording indicates income of a trust, and then it continues in subsection 1 and 2 to refer to amount. But I think that if you consider the wording of the section to state income, we, as a general rule, then also apply the term of net income, which is income after allowable expenses. All right, so I hope that clarifies that. Then filing requirements if the trust does not have an end of February year end. Now, I know there's not a lot of trusts that might be represented here tonight that do not have an end of February, but I'm just going to touch on that quickly. And that is that should you have a different alternative year end to that of 28 February, let's use an example. You have an end of June year end for the trust, and there may be reasons for that. You may be part of a group, or it might be a collective investment scheme. Then you are still required to submit the end of February return for tax purposes. So if X and Y Trust has a 30 June year end, they complete their affairs, then they will make use of the end of February return to submit their return, and they will not have to do a roll forward or roll backwards in terms of their amounts. They will merely use the figures for that period. All right, then I would like to talk about filing requirements in terms of provisional tax. My colleague has already touched on it, and Rofiwa from our team will also be touching on this in a little bit more detail in terms of the practicality. But I would just like to discuss how a provisional tax applies to trusts. I think there's been a lot of discussions, and we've had practitioners contacting us in this regard to discuss the provisional tax of trust. So Nozuko mentioned that there's no amount that qualifies you for becoming a provisional tax or a taxpayer for trust purposes. It is a similar situation for provisional tax, where if a trust earns more than R0 in a year of assessment, they become a provisional taxpayer. If they earn zero income in a year of assessment, then they do not qualify as a provisional taxpayer, and they will be a non-provisional taxpayer. And why is this important? It is important because the classification in terms of provisional or non-provisional would decide or would inform you in terms of when you should submit your return, and also whether you should or should not submit an IRP6 being a provisional tax return. So if you do qualify as a provisional taxpayer for the current year of assessment, your filing date was 24th of January, and if you were a non-provisional taxpayer, it was 23 of October of last year, being 2023. So it is important to make sure that if you qualify as a provisional taxpayer, and I use the word qualify because you no longer register for provisional tax, you qualify for provisional tax. And if you thus qualify for provisional tax, that you make sure that you do the periodic declarations, as Rofiwa will discuss with you in a little bit more detail, and also that you then comply with the correct filing dates. Now, in this regard, we would have representation in terms of trusts that are of so-called vested trusts, where all income are vested by the trust in a year of assessment. So if the trust earns 100, the trust deed would be a vested or vesting trust. It would declare that the full R100 would then be vested to its beneficiaries. Now, in terms of a resident trust, no problem if all of the beneficiaries are residents. However, with the amendment that was made to Section 25 Cap B during the last cycle, the legislative cycle, and my colleague Jan Kutsia will deal with this in a little bit more detail later, this changes that scenario, because in terms of this amendment to Section 25 Cap B, if amounts are vested to non-resident beneficiaries, then those amounts are to be taxed in the resident trust prior to the amount being distributed to the non-resident beneficiaries. So please make sure, if you are uncertain, We will, as Mark indicated, provide you with this presentation, and we will include a little bit more detail so that you are aware of the tax responsibilities that you have in that regard. All right. All right, then we get to another subject that both Nosipho and Nozuko touched on in just a little bit of detail. But ladies and gentlemen, this is part of our filing section of the webinar. And I need to make you aware of the fact that beneficiaries are required also to submit a return. Now, what is the ground rules there? If an amount is received by a beneficiary, and the beneficiary, remember, a beneficiary could be an individual, it could be a company, it could be another trust, or it could be another entity of whatsoever nature, depending on the trust instrument. So if amounts are vested, then you will have to consider the annual public notice that I discussed earlier, because there it will indicate you if you fall within one of those categories, whether you are to declare these amounts. I'm not going to go into too much detail on that. Rafiwa is going to be discussing that for us. Now, another interesting happening in SARS is, and this is to curb the current low filing rates, is the introduction of administrative penalties that will be introduced in September of 2024 for trusts. So as you are aware, administrative trust has been rolled out to individuals and companies already. And in terms of modernization process, the trusts fell a little bit behind, but we are catching up. And as of September of 2024, administrative penalties will be issued for the non-filing or late filing of returns. So please make sure that you try and file in time. More information regarding this will be available on the SARS website in due course. Okay, then I get to my final piece of the puzzle, and that is the introduction of the IT3T. Now, ladies and gentlemen, it has taken us a long time to introduce this specific requirement. And I would like to just give you some background as to why this is so important to SARS. Now, we have had a lot of engagement with industry around the introduction of the IT3T, and it was eventually introduced, tested in September of 2023, and it is now a live third-party data reporting format. So if you are a trustee of a trust and you do make or vest amounts to beneficiaries, you should now ensure that you enable yourself or get ready to submit your first IT3T return in and prior to 30 September of 2024, when the first date of submission for this third-party data reporting document is required. So just to the background, as I indicated, it was noticed by SARS that there was a significant difference, staggering amounts between the amounts declared by beneficiaries in their returns compared to amounts declared by trusts in their returns. So what does that mean for us? For SARS, remember that the amounts vested by the trust is an expense in the trust, which means that it reduces the amount of tax recoverable from the trust. Whereas if the beneficiaries do not declare those amounts, then SARS are out of pocket by those amounts. So we did more than one piece of research, and it is staggering amounts that we are talking of, and we will be following up on non-compliance in this regard. Again, I urge beneficiaries of trust to ensure that if you are and fall within the category of having to submit a return, then you must submit a return. I'm talking about either an IT14 for companies, or ITR 12T for trusts, or ITR 12 for individuals. Even if it comes your way through a partnership, remember that you, as a partnership, you will then fall within the category of an individual. So please make sure that you submit your returns. Non-compliant behavior in this regard, as Sam indicated, will not be taken. We will be harsh in terms of penalties. So, ladies and gentlemen, that is my part. If there's any questions on the IT3T, we will be doing some editorials on the SARS website to educate you in terms of how to register and get yourself ready for submitting your first IT3T. Please look at the SARS website. But failing that, please send us an email to trustquestions@sars.gov.za, as Mark has indicated numerous times. Thank you very much for your time. I now hand over to my colleague, Nonchalantla.
Michael is handing over to Alvino. Good evening, all.
Sorry, Alvino.
I'm Alvino Prince, and I'm a specialist engineer within the process design and engineering team. On an annual basis, all changes and other required form changes based on operational enhancements are implemented prior to the release of the ITR 12T for the new year of assessment. These changes follow a rigorous process of extensive consultation, brainstorming, and design thinking sessions prior to the release of the new return. Enhancements or new requirements released June 2023 included beneficial ownership information, declaring amounts received from other trusts, which is a new container, passive trust, and all other legislative and operational enhancements. Specifically focusing on passive trusts. What is a passive trust? A passive trust may be compared to a dormant company. However, note that a passive trust is also required to submit a return. From the 2023 year of assessment, a shortened return is required for passive trust. Note, however, that there are certain wizard questions that need to be completed prior to submitting a passive trust return. The questions relate to beneficial ownership and loans with a Section 7 Cap C implication. Thank you. I'll now hand over to my colleague, Nonchalantla.
Thank you, Alvino. Good afternoon, everyone. My name is Nonchalantla Kumalo, a team member in the trust segment holding an LLB degree. For my part of the presentation, I'll focus on the requirement for accurate disclosure on the ITR 12T, as well as the audit and verification processes. So when you're submitting a tax return, the disclosure on the ITR 12T must be full and complete in all material respect. When error has been made on the material facts disclosed or when completing a return, SARS allows taxpayers to rectify such errors on e-filing through a request for correction. Once a request for correction has been submitted on an ITR 12T for the relevant year of assessment, no action can be taken on the previous version as it will be replaced by the new version. It is important to note that a complete revised return or declaration must be submitted, not just the differences. To submit the request for correction, you need to open the applicable return and select the Request Correction button. Should this button be grayed out, it means that the request cannot be submitted by the taxpayer. The request for correction will not be allowed when an audit case or verification has been completed or SARS has made a revised declaration. In instances where a request for correction has been submitted, supporting documentation has been submitted, or there's an ongoing audit, the taxpayer has to wait for the outcome. Thereafter, an objection can be lodged. An objection has to be lodged within 80 business days after the date of the assessment or SARS decision. Where the taxpayer requested reasons for the assessment, the objection must be submitted within 80 business days after the notice sent by SARS that adequate reasons have been provided and that no further reasons will be provided, or the date SARS provided you with the reasons or further reasons. The taxpayer entitled to object an assessment or decision must object in the manner, under the terms and within the prescribed period. Even though Section 104, subsection 4 of the Tax Administration Act deals with the extension, it should be noted that the period for objection would not be extended for a period exceeding 80 business days if there are no exceptional circumstances which gave rise to the delay, or where it has been 3 years after the assessment, or where decision was not allowed. Moving to the second part of my presentation, which is verification and audit processes, it is important to note the difference between the two. Audit and verification are separate processes. Verification means SARS would check the information that the taxpayer gives in a declaration or tax return. SARS compare this information to against third-party data, financial and accounting records, and other supporting documentation. Through verification, SARS ensures that the taxpayer's declaration or return is fair and accurate. Once declaration or return is submitted, SARS can choose to verify the document. While an audit means SARS examine your financial statement, accounting records, and supporting documents to check that you correctly declared your tax position. If the taxpayer did not file a declaration or tax return, the audit will investigate if the taxpayer's action comply with the tax law. When selected for verification, SARS will notify you with an official letter that you have been selected for verification. The letter will stipulate the timeframes within which you must submit either supporting documentation requested by SARS on e-filing or the SARS online query system, or if you want to change your original declaration, you may submit a request for correction, which I have explained its process. During the verification, SARS can ask you to upload more information and will attempt to finalize your case within 21 business days after the documents have been uploaded. In the case where there is a refund due to the taxpayer, it will only be paid after verification has been finalized. And if SARS finds that your tax declaration or return is incorrect, a revised assessment will be issued. Where SARS identify that the amount of tax you owe is understated, SARS can also levy penalties. One would ask, what happens if you do not submit a request for correction or upload the required document? Well, SARS will send a second letter. If still there is no response by the deadline, SARS will issue a revised assessment based on the information that we have. Once verification is completed, where there is no issue with your tax position, SARS will send you a notification on e-filing or a letter through email or post that your verification is complete. Where there is a discrepancy, SARS will issue a notice of assessment based on the revised assessment through e-filing, email, or post. Where a financial risk is posed by your tax position, SARS will issue a referral for audit letter through e-filing, email, or post. Your tax return or declaration is then referred for an audit. If you have a refund due, the refund will be paid only once the audit is complete and you have passed the refund validation. You can dispute the findings of SARS verification. As I have mentioned, SARS can audit you even if you have verified your tax position. A notification that SARS referred you for an audit does not mean that the audit has begun. Your audit officially begins when SARS sends you a notification of audit letter, which states that your audit has been allocated to a specific auditor. Your notification of audit letter will tell you which documents to submit by a certain deadline. Alternatively, SARS will arrange to conduct a field audit at your convenience. In the case of a field audit, you can recover photocopy costs from SARS if you meet certain requirements. The information that SARS will ask you to submit will depend on the tax type and the scope of the audit. SARS can also obtain information from any third party. while SARS prepare to receive audit documents electronically and can arrange for an electronic forensic specialist to download this from your computer. Physical documents can be submitted at a branch. If you are an e-filer, you can scan your material, save them on your desktop, and submit this information on e-filing. Remember, after uploading, to click the Submit button to send the document to SARS. Alternatively, you can arrange with the auditor indicated on the letter to collect your audit documents or to have them delivered. So it is important to read your notification of audit letter and note the contact details of your SARS auditor. SARS will prioritize finalizing an audit within 90 business days from the dates that we receive the audit documents requested from the taxpayer. If SARS finds no issue with your tax position, a finalization of audit letter will be sent through e-filing, email, or post to conclude the audit. If SARS finds that your tax position should be adjusted, within 21 business days, an audit finding letter will be issued explaining the grounds for the proposed assessment. The taxpayer is granted at least 21 business days to respond to the audit findings letter. If the taxpayer disagrees with SARS findings, a dispute can be lodged and evidence to support the dispute should be furnished. If taxpayer disagrees with SARS original tax assessment based on an estimate, a completed and correct tax return can be submitted within 40 business days from the date of assessment or the due date. If SARS still believes that the audited taxpayer understated their tax position, SARS can levy penalties up to 200% of the shortfall. SARS can levy harsher penalties for repeated cases of tax understatement, obstruction, or evasion. SARS will revise the tax assessment after imposing the penalty. SARS will use e-filing, email, or post to issue a notice of assessment and a finalization of audit letter, which details the ground of the assessment, amounts due, and payment deadlines. Tax refunds due to you will be paid after the audit. For taxes that are not assessed by you, such as income tax, SARS assessment normally becomes final within 3 years from the date of assessment. However, SARS can reopen an assessment if we find evidence of fraud, misrepresentation, or non-disclosure. SARS can extend the date on which an assessment becomes final in some cases. At any time during verification or an audit, taxpayers can approach the voluntary disclosure unit to share information voluntarily. Taxpayer can make reference to the voluntary disclosure program for guidance. This page can be accessed in different languages. Thank you for your time. Now I'll hand over to my colleague Lana. Over to you, Lana.
Thank you very much, Noshanzla. My name is Lana Pinkham. I'm a chartered accountant, and I will continue now. I've got some good news for you tonight. The trust dispute process is currently a manual process using the alternative dispute resolution forms, that's the ADR1 and the ADR2 forms, and was lagging behind the other core taxes, PIT, CIT, VAT, and pay-as-you-earn. Trusts as a tax product was previously omitted from the modernization program. Trust disputes will now be aligned with the other core tax products. This means that trusts will be able to lodge disputes via the automated case management system on e-filing as planned from April 2024 onwards. I hope this is some good news for you. Further details will be published on the SARS website, including the transitional measures that goes within digitalization of disputes. I will now answer a few questions. How do I know how much money is the trust I am presenting owing to such? There are two options. The first option is you refer to the statement of your account. The trust statement of account, which can be obtained on e-filing or alternatively by visiting a SARS branch, will indicate the balance that the trust owes SARS. The balances will include the totals of any tax assessments raised, interest and penalty levied, and any payments made on the account, including provisional tax payments made. The second option is you can contact the SARS call centre and request them to provide you with the outstanding amount that the trust owes SARS. Now I'm going to deal with a second question. How do I settle a SARS trust debt? A payment advice is found at the bottom of your trust statement of account. The payment advice contains the following information: the payment reference number, that's the PRN, that consists of the trust reference number that is followed by a T and 8 zeros, the names of the banking institutions where you can pay your trust tax debt, the SARS bank account's name in which the money should be deposited or transferred to. The trust debt can be settled via an electronic fund transfer, a EFT, from the trust taxpayer's bank account to the SARS tax account by using the payment reference number, the PRN. Icona will show you a little bit later tonight how to do this payments on the e-filing screen. If you can't settle your trust debt in full, please take note that you may make use of the payment arrangements with SARS. The Tax Administration Act, Section 167 and 168, provides an option to do a deferral of payment arrangements for outstanding debt if a trust complies with the requirements. Deferral allows trusts to pay the tax liability in installments within an agreed period. Please note that a deferral does not eliminate the trust tax liability. Finally, provisional taxpayers are reminded to pay their provisional tax on time. I will now hand over to my colleague, Rofiwa, and just please take note, the questions we are unable to answer tonight, we have a dedicated question email address. Please use that, and we will do our best to answer all your questions that we could not answer tonight. Thank you very much. Rofiwa.
Thank you, Lana. I'm going to take you through provisional tax and the penalties and interest related to it. What is provisional tax? Provisional tax is not a separate tax from income tax. It is a method of paying tax in advance to ensure the taxpayer does not have to pay large amounts on assessment, as the tax liability is spread over the relevant year of assessment. It requires the taxpayers to pay at least 2 amounts in advance during the year of assessment, which are based on estimated taxable income. A third payment is optional after the end of the tax year, but before the issuing of the assessment by SARS. On assessment, the provisional payments will be offset against the liability for normal tax for the applicable year of assessment. The due dates for provisional tax payment. We have the first period. This payment must be made within 6 months from the commencement of the year of assessment in question. This means that for the year of assessment that starts on the 1st of March and ends on the 28th or 29th of February, the first period for which provisional tax becomes due will be the period ending 31st of August. And the second period, this payment must be made not later than the last day of the year of assessment in question. This means that for the year of assessment that starts on the 1st of March and ends on the 28th or 29th of February, the second period for which provisional tax becomes due will be the period ending 28th or 29th of February. The third period. This payment is also known as additional or topping up provisional payment and must be paid not later than the effective date. The effective date is 7 months after the financial year end, which is the 30th of September. And now we have the penalties and interest. A penalty may be levied when the actual taxable income is more than the taxable income estimated on the second provisional tax return, provided you did not top up the third provisional tax payment. The payment amount depends on whether the actual taxable income is more or less than 1 million rand. And if a provisional taxpayer fails to pay the provisional tax in respect of the first and second periods, before their respective due dates. A 10% penalty will be levied on the unpaid amounts in terms of paragraph 27 of the 4th schedule to the Income Tax Act. And interest in terms of section 89 bis is levied at the prescribed rate, currently 10.5% per annum, and is payable on late payments in respect of first, second, and third periods. Interest in terms of section 89 quat is either levied on an underpayment of tax or paid on an overpayment of tax from the effective date, and is calculated as follows. Interest in terms of section 89 quat 2 is payable by a provisional taxpayer if the normal tax exceeds the credit amount, that is an underpayment of tax. And if in the case of a trust, the taxable income for the year of assessment exceeds 50,000. Interest in terms of section 89 quat 4 is payable to a provisional taxpayer if the credit amount exceeds the normal tax payable for that year of assessment and the amount exceeds 10,000, or the taxable income for the year of assessment exceeds 50,000 for a trust. This interest is payable to the taxpayer at the prescribed rate, currently 3% per annum, subject to changes as published in the Government Gazette, on the amount by which the credit amount exceeds the normal tax. Interest paid to a taxpayer by SARS on an overpayment is taxable and must be declared under the interest income in the tax return for the tax year in which it is received. Thank you. I now hand over to my colleague Jan.
Good afternoon, ladies and gentlemen. As Rafiwa said, my name is Jan Kutsia, and I hold a BCom Law, LLB, and an LLM degree. I'm an admitted attorney of the High Court of South Africa. I'm a member of FISA, the Fiduciary Institute of Southern Africa, and also a member of STEP, the Society for Trusts and Estate Practitioners, and an admitted attorney of the High Court of South Africa. I recently joined SARS, as Sam in her introduction mentioned that they got skills, SARS got skills elsewhere. I'm a newly appointed external employee for SARS after spending nearly 28 years on the other side of the fence, so to speak. And the issues that I'm going to discuss this evening are typical issues that I picked up in practice. And I find it that there's still a lot of misconception, especially when it comes to Section 7 Cap C. There was a question raised earlier in the chat regarding the payment of donations. I'll get to that in a minute. But just to set the scene and to take the discussion forward, I would like to give a small example. So I'm not going into the rationale for the introduction of Section 7C, the reasons and so on, and the commissions in the 90s, Katz and recent Davis. Not going into that, but let's look at an example and see what potential taxes the fiscus loses out when a trust mechanism is in place and used correctly. So let's assume that there's a funder, estate planner, and this individual is advised to create a trust. The original corpus of the trust would be a nominal amount, 1,000 Rand or even 100 Rand, donated by this funder to the trustees to keep in trust for and on behalf of the beneficiaries. The trust deed is your governing document, and this gives the powers and obligations to the trustees what they can do. Now, let's say there's R1 million available. How would the funder get the R1 million into the trust? So there must be a causa for change in ownership from the individual to the trust so that the trust can utilize the R1 million. Now, the funder can either donate it to the trust. Now, we know any amount in excess of 100,000 Rand per annum will be subject to donations tax. So the funder doesn't go that route. So instead, the funder lends the money to the trust, and the terms and conditions are very favorable in the sense that the loan is repayable on demand, and it is a zero or a low interest loan in comparison to the official rate of interest, to which I'll get in a second. So the trustees then take the R1 million and they endeavor to let it grow, and they adhere to their fiduciary duties and responsibilities, and they invest wisely. So fast forward, let's say 20 years, and let's say for purposes of our discussion, the R1 million is now 20 million rand. But for estate planning purposes, the estate of the funder is now pegged to the tune of R1 million, because that's the loan that the trust owes the individual. So the net asset value of the trust, my little example, is 19 million. Assets of 20 million less the loan of $1 million, hence 19 million. Now let's look at the potential taxes that the fiscus loses out in this little example. First of all, it's donations tax. I alluded to it earlier. The second one is interest received from the person to the person who made the loan. There's no interest to declare, so no interest is payable there. And now the big one, ladies and gentlemen, is estate duty, the 19 million rand. And that's out of the net for estate duty purposes. Hence the reason for Section 7 Cap C. Now, how does 7 Cap C work? On that funding of R1 million in my example, if the interest is lower than the official rate of interest, or even zero, the difference between the official rate of interest and the interest charged, we all know, will now be a deemed donation. Now, ladies and gentlemen, this is a fiction, this donation. It's not interest received, and I'll get to that in a second. It is a pure fiction of law. Okay, so that's high level. So any loan, advance, or credit to this trust will be subject to 7 Cap C if no interest, or the interest charge is lower than the official rate. This piece of legislation was enacted and made applicable from the 1st of March 2017, even for those loans granted before that date. So it's on or after. And 7C has gone through various amendments due to schemes trying to evade the 7 Cap C. Now, for this section to work, there must be a nexus between the trust on the one side and the person who made the donation, who made the loan to the trust. And that nexus is called a connected person. Now, it's important to understand who is a connected person in relation to a trust. Now, here we go to the definition of connected persons as contained in Section 1 of the Income Tax Act. Now, in relation to a natural person, any relative and any trust of which such natural person or such relative is a beneficiary. So if you are a beneficiary of a trust, the trust and you are connected to each other. Now let's look at from the other side. In relation to a trust, who's a connected person with a trust? Now, in relation to a trust, any beneficiary of such trust, now here comes the drum roll, ladies and gentlemen, and any connected person in relation to such beneficiary. Now, let's have a look at the definition of relative, also contained in the Income Tax Act. Now, relative is defined in relation to any person, means the spouse of that person. So your spouse is already a relative by means of the definition. So let's go back. Any relation to any person means the spouse of that person, or anybody related to that person or that person's spouse within the third degree of consanguinity, or any spouse of anybody so related. So what does this mean from a practical point of view? So you stand here, any people 3 degrees up, 3 degrees down, and 3 degrees sideways from you is a connected person. Now let's jump to your spouse. Any people 3 degrees up from your spouse, 3 down, 3 sideways, will be connected to your spouse, and by virtue of that connection will be also connected to you. Now, ladies and gentlemen, why is this important? I've come across structures whilst advising individuals on the other side of the fence, if you will, that gave money to a brother-in-law of a spouse, for instance, to try and avoid the provisions of 7C. Unfortunately, you're still within the net. So importantly, ladies and gentlemen, is to understand who is connected to the trust for tax purposes. As I said, 7C applies to any loan, advance, or credit made to a trust. Now, ladies and gentlemen, the following point is very concerning. Once again, I gathered this during my tenure on the other side when I advised clients. Now, there was a question posted on the chat. I think, if my memory serves me correct, Paul, you asked the question, so what's the difference between a dormant and a passive trust? And I'll get to that in a second, but let's use a non-economic active trust for purposes of our discussion. So now we've got this trust. It's not registered for tax purposes at all, but it owns lifestyle assets, farms, vacant land, holiday homes, game farms, if you will, any sort of a lifestyle asset, classic cars, assets that tend to appreciate in value. Now, the question immediately arises is, where did the trust get the money to purchase these assets? So, was it a loan? Was it a donation? Where did the trust get the money? There was also a question posted on the chat. Now, what about if this trust only owns a primary residence and no activity is going on? If you refer to my colleague Nozuku's presentation, where the commissioner, by virtue of annual notice, determines who must register for tax, a trust's name is there. So the economic activity of the trust is irrelevant. A trust must be registered for tax. Now let's jump down to the official rate of interest. Once again, ladies and gentlemen, it's a defined term in the Income Tax Act. Basically what it says is it is the repurchase rate, the ZAR repurchase rate, plus 100 basis points. Now, if the loan is denominated in a currency other than the South African rand, well, the equivalent of that currency's repurchase rate plus 100 basis points. So there's your line from where you work. Any interest less than that, well, is a deemed donation. Now, ladies and gentlemen, I received a lot of questions. What to do with this deemed donation? Must I now disclose it on my income and expenditure account as interest received, and must the trust disclose it on its income and expenditure account as an expense paid? And the answer to that is no. Nowhere in any financial statement is a deemed interest payable or received. It is a mere fiction of law, and it is calculated at year end, and I'll get to that in a minute. So, okay, that I addressed. Okay, now the question now arises: when is this donation deemed to have occurred? Now, if you look at 7 cap C brackets 3, will be treated as a donation made to the trust on the last day of assessment for the trust or company. So, ladies and gentlemen, it's today. So today will be the deemed donation. When must donations tax be paid? Now, this is also very important. The value to be used on which your deemed donation is calculated on the moving daily balance of the loan account throughout the year of assessment. And why do I say this? Once again, I've come across instances where the opening value of the loan account and the closing value of the loan account in that year of assessment is added together, divided by 2 to get an average. The other method that I've seen as well is we look at what's today's value and we multiply that with whatever the rate is. And that's incorrect. So that's why it's of paramount importance to make sure that the accounting records are up to date. I want to say live, if you will, so that you know exactly what the liability is. Why is this important, ladies and gentlemen? Because this leads me to Section 60 of the Income Tax Act. Because if you look at Section 60 of the Act, which deals with when the donations tax must be paid, it says, by the end of the month, following the month during which a donation takes effect. Now, when does the donation take effect? Well, it's today. So now we say within the month following the month, well, that will be the end of March. So by the end of March, the donations tax must be paid. Once again, not when the financials 6 months later are approved by the trustees or put forward for approval by the trustees. It's today and within a month from today. Now, here's the question. Well, I'm answering the question in terms of where and how to pay donations tax. Well, if you go to the e-filing profile, and I think it's on the left-hand side of the profile, you will see there's a drop-down box that says payment. You click on that, and then you create an additional payment, and you click on type of tax, and voila, you choose donations tax. And donations tax currently is, for want of a better word, a self-assessment. I think Mark Kingham answered also a question there that it is a process of modernization. A team within the donations tax sphere is looking into that to modernize that as well. So it is a manual process currently. Now, ladies and gentlemen, if you look at the 4 pillars of compliance, which we've been dealing with throughout the presentation, namely registration, filing, declaration, and then the end of the day payment. When it comes to declaration of your donation, remember the taxpayer is already registered. It's the individual. It's not the trust. It's the individual that's deemed to have made the donation. So that taxpayer is already on register. You've got to submit an IT 144, a declaration of donation, in which you declare the donation, in which you calculate the donations tax payable, and you submit that at the branch. Okay, ladies and gentlemen, let's move swiftly along. I think it was the 22nd of December last year, the Taxation Laws Amendment Bill was enacted, and 2 amendments to Section 7 Cap C were introduced. And the first one is the introduction of a new Section 7 Cap C brackets 3 Cap A. And in essence, what this section now tells us is that where a loan is denominated in a currency other than the South African rand, the exchange rate to use to convert to ZAR for purposes of calculating the deemed donation, you've got to use the average exchange rate during the year of assessment. Then another although this presentation deals with tax and trusts, it's very important to understand that there's an obligation on the trust where the trust received an inward loan. So it made a loan from a non-resident source, that in terms of the South African Reserve Bank currencies and exchange manual for authorized dealers, Section I, India 3, that loan must be placed on the financial survey, must be placed on record through the financial surveillance department of the South African Reserve Bank. It's just an obiter remark. If you don't do that, well, then you're in contravention of the exchange control regulations. The second amendment to 7C was the amendment to 7C5D. Now, 7C5 deals with exclusions to the deemed donation dispensation, and it deals with primary residence. Now, ladies and gentlemen, why is this important? Once again, during my advisory days, I picked up that there's a misconception as to what is allowable to be excluded. First of all, if you look at the requirements, the loan must be used by the trust to acquire property to be used as a primary residence. Up until the amendment, improvements were done on loan accounts. And with the amendment now, those improvements, the value of the loan attributable to or by which the trust used for the improvements will now also be excluded. But here's the concern. Lumped into this loan account are amounts that the trust used for maintenance, for rates and taxes, for levies, and the like. Now, ladies and gentlemen, those amounts are subject to Section 7C5, I beg your pardon, 7C, and are not excluded in terms of 7 Cap 7 cap C5. So you'll have to strip it out, and any loan portion utilized for purposes other than acquisition and for purposes other than improvements will be subject to 7C. And these amendments are effective from 12 o'clock tonight, the 1st of March 2024 going forward. I hope that's clear. Okie dokie. Now, Michael referred to 25 cap B earlier. What are the tax consequences if a resident trust vests an amount of income to a non-resident? Now, we all know the well-known Armstrong case, which is a 1938 appellate division case. And a bit later, from the same bench, the Rosen case that came about in 1971 said basically that income retains its identity when it flows from the trust to its beneficiaries. And that's where the conduit pipe principle came about. So any income vested in terms of 25B1, if the beneficiary has a vested right to income, will be taxed in the beneficiary's hand, alternatively in the trust. All of this obviously is made subject to the anti-avoidance provisions contained in Section 7 of the Income Tax Act. 25 Cat B2, where a beneficiary receives a vested right to income, whether the income is transferred or not, paid, for instance, on loan account, the beneficiary must still pick up the tax bill there. So let's park that for a minute. Let's go now to the 8th schedule. And to be exact, paragraph 80 brackets 1 and 80 brackets 2. Now, 80 brackets 1 says that where an asset is vested in a resident beneficiary of South Africa, the flow-through conduit principle for tax purposes will apply, and the resident beneficiary will pick up the tax bill. 80 brackets 2 is where the trust realizes a capital gain and then vests the capital gain by virtue of the provisions of the trust deed in the beneficiary. Well, the resident beneficiary of South Africa, the resident beneficiary will pick up the tax bill. Now, ladies and gentlemen, specific reference to resident beneficiary. So where a trust distributes an asset in specie to a non-res or disposes of the capital gain realized as a result of the disposal of the asset in a non-resident beneficiary, unfortunately, the flow-through for tax purposes does not apply. The South African trust will pay the tax. Back to 25B. So now we see there's a misalignment, if you will, between the provisions of the 8th schedule, 80 to be exact, and 25 Cap B of the Income Tax Act, with reference to non-residents and residents. So the amendments that came about, also applicable from midnight to night, basically means that any distributions or vesting of benefits, income benefits, that is, to a non-resident beneficiary will now have to be taxed in the hands of the South African Trust. Yeah, I said that will be effective from tonight, midnight. Now, ladies and gentlemen, the following one is very, very interesting. Now, Michael alluded to it earlier. I'm not going to dive too deep into it. Suffice to say, there's a lot of non-compliance by beneficiaries of trusts, where vestings occurred, distributed, or left on loan account in favor of the beneficiary, where the beneficiary never disclosed it for tax purposes. And as Michael said in his presentation, the numbers are huge. So we are currently busy with the process to investigate non-compliance, where beneficiaries received distributions out of trusts, and these were never disclosed in the beneficiary's hands, and assessments will be raised for non or under declarations. We've mentioned earlier that the IT3T third-party reporting obligation will commence from the 30th of September of this year going forward, and this will allow SARS to pre-populate beneficiary returns for years to come, so that there is no more tax leakage, because distributions could occur in year 1, but declaration from beneficiary, one, never happens, or two, could happen 5 years down the line. And once again, Michael, I'm using your name a lot because I'm taking a lot of your stuff that you said. Beneficiaries include individuals, companies, trusts, and even close corporations. I'm not going to hover too long on the following topic because our colleague, our corner, will be addressing it a bit later. But in my tenure with SARS, I received a couple of queries relating to change in tax practitioner profiles. Now, the case at hand was the trustee resigned as trustee, relinquished its responsibility as trustee. A new trustee of the trust was appointed. The trustee also acted as tax practitioner for the trust, resigned as tax practitioner. Fast forward 13 years, the same tax practitioner got correspondence from SARS, was notified, please go look, there's correspondence from SARS on your profile that requires your urgent attention. In this case, the tax practitioner has got no idea where the client is, the trust and the trustees. He relinquished his relationship 13 years prior to the date. They can't access the profile because the trust is not on their profile anymore. As I said, I'm not going to hover too long on this. The message that I would like to get across, ladies and gentlemen, is to make very sure that when you hand over the file, if you will, to the next person, that the next person updates the profile correctly on SARS system. That concludes my bit of the presentation, ladies and gentlemen. And I'm now going to hand you over to our colleague, Manae Hendricks. Manae is the head of our SARS tax exemption institutions. Manae, over to you. Thank you very much.
Thank you so much, Jan. Good evening, ladies and gentlemen. My name is Manae Hendricks, and I'm the head of the tax exempt institution segment. Thank you very much to our colleagues in the trust product who invited us this evening to be part of the seminar. I do think, though, it speaks to what Nazuko said. All trusts are taxpayers and none of them are exempt from tax unless you have been approved by the tax exempt section in SARS to be exempt from tax. So I'm not going to go into too much detail tonight about tax exemption status, but I just want to touch on those elements that relate specifically to trusts. And as you may know, certain philanthropic trusts may qualify as tax-exempt institutions. And here we may only consider testamentary trusts and inter vivos trusts. It specifically excludes special trusts from applying for exemption from income tax. Then, depending on the objectives and the activities conducted by the trust, applications may be made for classification as one of the following types of exempt categories, and that is either as a public benefit organization or a PBO or a small business funding entity or an SPFE. If you have submitted the application to SARS and we've approved you as an exempt institution, there will be certain rules that will apply to that trust that may differ from what our colleagues have been sharing this evening on the compliance requirements for trusts. Firstly, we want to emphasize that partial taxation rules will apply on approval by SARS, and taxation is based on the sources of income, and certain income may be exempt if it meets the exemption criteria. Other income will still be subject to tax based on the normal trust taxation rules. And I may just add, Jan spoke a lot about donations tax. If you are approved as a tax-exempt trust, then you will have exemption from donations trust. It's important to note that if you are approved as an exempt institutions trust, you will submit a different type of return, namely an IT12EI. And the tax rate applicable to PBO trusts or exempt institutions trust is 27%. So we apply the tax, the CIT tax rule. We have also been asked to speak specifically to you about the approval of tax deductible donations, or Section 18A, as it might impact on you either as a trust who gives donations or possibly as an exempt trust that has been approved for Section 18A purposes. And ladies and gentlemen, I do want to invite you. We had a special webinar on Section 18A. So tonight I'm just going to touch very shortly on a few principles. As we said, you have to apply for additional Section 18A status. It is not automatic, and it is not automatic when you are granted PBO status. Unfortunately, small business funding entities do not qualify for Section 18A approval. So depending on your public benefit activities, you may be granted Section 18A status, and these activities include welfare and humanitarian, healthcare, education and development, conservation, environmental and animal welfare, and then importantly, the provision of funds or assets by conduit PBOs. We do know that quite a lot of the trust-exempt institutions are conduit PBOs, where they provide funds or assets to other PBOs. You do get two types of Section 18A approval. You can either be a doer, which is the PBO conducting the qualifying activities, or you can be a conduit or a funder PBO. And that is where you provide funds or assets to other approved PBOs or government institutions that qualify with their activities. So as I mentioned before, we do know that quite a lot of trusts fall in the conduit qualifying section. If you have been approved as a PBO with Section 18A status, you have additional funding requirements. With effect from the 1st of March 2023, you have to issue a receipt that meets all of the requirements for a valid receipt. And the additional reporting requirements were added from the 1st of March 2023. You have to submit an annual income tax return, the IT12EI, in which you will disclose the Section 18A information, including the number and the value of the Section 18A receipts issued. And then if you are a conduit PBO, there are certain distribution requirements which have to be met within 12 months after year end. Ladies and gentlemen, as I indicated to you previously, you may be a trust that is issuing Section 18A receipts, or you may be receiving Section 18A receipts. So the consequences of non-compliance with Section 18A requirements impacts on, firstly, on the entities that issue those invalid receipts, and the donees. The amounts can be taxed in the hands of the donees, and the Section 18A and the tax-exempt status can be revoked if you have issued these receipts incorrectly or for improper reasons. Then if you are the donor that is claiming an invalid Section 18A receipt, the claim will be disallowed in the hands of the donors. And I think very important for our trustees this evening, if you are the responsible person or the trustee of a Section 18A PBO trust, you may be found guilty of an offence and on conviction liable to a fine or to imprisonment for a period not exceeding 2 years. So as you can see, if you are a PBO with Section 18A status, there are additional reporting requirements. And then, ladies and gentlemen, I appreciate it's been a very long evening, so I'm wrapping up just with the PBO trust reporting requirements, and to say that certain exempt trusts may have additional reporting obligations. You may have to submit an audit certificate under certain requirements, and that has been set out in Interpretation Note 112. And then, as Michael mentioned this evening, the IT3D, the reporting of donations made for which tax deductibles, my apologies, ladies and gentlemen, it's a long evening. IT3D belongs to me. So if you are an institution that has issued tax deductible donations, you will in future have to submit an IT3D or a third-party data submission to SARS, indicating to whom you've issued this receipts as well as the amounts for which you have issued these receipts. And SARS will be gradually using these IT3D submissions to pre-populate returns, but also importantly use it as a verification mechanism to detect risk and fraudulent or incorrect issued receipts. And importantly, I know we've received a lot of questions. Our exempt institutions trusts, there may be instances where you also have to submit an IT3T, as was mentioned this evening by Michael, and this is where a trust has made a distribution to beneficiaries listed in the trust instrument. And so as you can see, there may be instances where you have to submit both an IT3D as well as an IT3T if you are an exempt institutions trust. And ladies and gentlemen, I'd like to thank you for attending this evening. As I mentioned, we do have more detailed information on how to apply for exemption, as well as our Section 18A webinar available on the SARS website. I'd like to hand over to my colleague Akona, who will give you some more details. Thank you so much.
Icona will be bringing up the data. Thank you very much, Mane. She'll start the presentation and then kick off. But thank you, Icona. Just we'll give you a second while you bring it up. There you go. Thank you, Icona. You're muted, Icona.
Thank you so much, Mine. My name is Akona, and I'll be taking you through the presentation in relation to e-filing. We have Welile on the chat. This is a summary or an overview of what we will be looking at on today's presentation. The purpose of this presentation is to assist taxpayers with the registration of the trust on e-filing, activation of tax types, and as well as on how to access the returns on e-filing. It is important for taxpayers to update their registered representative, or we may call main trustees at SARS, before adding their trust on e-filing. You can use the SARS online digital channels, or you can make an appointment from the SARS website to be assisted with appointing the main trustee. It is also very important that we understand that the trustee or the representative that is appointed as a main trustee on e-filing, that their personal details are also updated at SARS. This is where you can actually find the link, or let me rather say, the online channel on the SARS website on where to appoint a registered representative, or rather we say a main trustee. Once you have appointed a main trustee, you can then now register on e-filing. In a case where you are not registered on e-filing, if the system says that you are already registered, you can then use forgot username. Once you get your credentials and you probably forgot your password, you are also able to use forgot password. Then you can log in on your e-filing. Once you have logged in on your e-filing, it's also very important for you to check your user rights. This will help you to be able to work properly on e-filing, and as well as be able to add the companies. You can just go to user on the top menu and your left menu. Then you make sure that you click on change details, update rights, and update your details. That is how the screen will eventually look. And please make sure that you have ticked manage payers as well, so that you are able to add your taxpayer or your trust on e-filing. Once you're able to add your trust on the e-filing, or you have the correct rights, then now you can start adding the taxpayer on e-filing. You just go to your organizations on the menu, top then left, you register new, you capture correct information. Please make sure that the information is exactly as it is on your document and as well as at SARS. Then you will not have any challenges adding the taxpayer onto the trust. That is how exactly it will look. If you are looking at the screen, we also have where we say registered representative. If you can see the arrow, that is where you can actually add the trust on a registered representative profile. You can just click where it says click here instead of capturing the details manually, and e-filing will populate the companies that are linked to the representative. Then you can just add. It is very important that when you capture the entity details manually using the one below, you choose or you select the correct trust type. And that is how the form will actually look. Please make sure that the trust number, the names, and everything are exactly correct. Then you can add your taxpayer. Once your taxpayer is added, you now want to activate the tax types or to manage the tax types so you are able to access your returns. You also go to the menu on organizations, manage tax types, you action and you submit the tax types. That is how the screen will actually look. You just click on activate and then you submit. Once it's successfully activated, you will see that the status will change from not active to successfully activated. This screen will show how action looks in a case whereby you've added the taxpayer, but you do not have or you did not appoint the main trustee. Your action will show as not available. So it is important that before you add your company on e-filing, you ensure that the main trustee is appointed at SARS and they have personally updated their details at SARS as well. In a case whereby the trust is already with someone else, then you will also be able to request the tax type transfer under action. Once your tax types are active, you are now able to go and navigate and submit your returns. You just go to the menu, returns top left, then you click on returns issued, you select the period, you request the return and submit. That is how exactly the screen will look. So please make sure that you request for the correct period and then you click on request return. That is how it will eventually look. It will show you the return type you have requested. It will show you the status that is issued. Then you can click on open. Once you click on open, the income tax page will show. And then where it's highlighted red ITR 12T, you can then click there to open, you complete your return and you submit. Once your return is submitted, your status will change to filed through e-filing. In a case whereby you have made a mistake and you want to request for a correction, you are also able to request for a correction on e-filing. You will notice that on the second screen below, once you click on request for correction, the system automatically opens a second version of the form. You will see that it says version 1, which is the one you filed through e-filing, and version 2, which is the one that is saved. Then you open that, you do or amend your return, then you submit. Once you have submitted, you probably want to query your status or to check your status. You are also able to click on query status on the income tax work page, and then you check your status. In a case whereby supporting documents are requested, you will be able to upload documents on your e-filing using the link where it says compulsory supporting documents. You are also able to request your statement of account to check whether you owe SARS or not, or to check your notices. You can always go to SARS correspondences to check your notices, or you can also go to income tax work page after you have submitted your return. You will notice that it gives you the link which says request historic notice. Then you can select there your notices and view your notices. In a case whereby you want to make payment, you are also able to use the additional payment on e-filing. You just go to your returns, payments, pay now, and then you create an additional payment. It is very important that when you are creating an additional payment, you use a correct payment reference number. You can get the reference number from the statement of account. Thank you so much for listening to me. I will now hand back to the program director.
Thank you very much, Aikona, and we appreciate what you've shared. No doubt there will be lots of questions, as we are seeing lots of questions in the room today. Just to those watching here today, we've got basically 10 to 13 minutes left, and there's quite a lot of questions that we are still trying to answer. We will get to them, and we will try and get them dealt with in terms of giving feedback. Just a reminder of the earlier email address that we had for questions, and that is trustquestions@sars.gov.za. I would also like to just make sure that you are aware of our website, and there are other tools that are available to allow for assistance. And before we get into some of the questions, and Monet, I'm giving you a heads up, I'm starting with you. Just a reminder also, please, to complete the survey, and we would ask that you do that at the end of the time. We do recognize, though, that we haven't addressed everything as yet. And I'm sure from this, I'm picking up, and our colleagues from the team that arranged this, picking up many donations tax issues that need to be addressed. But watch the space, we'll get back to you in that. But firstly, I'm going to hand over to Alvina to coordinate this, but I'm going to kick off with Monet first, if you don't mind. Monet, I'm going to hand it over to you first to answer the one question specifically. Thank you.
Sorry, Mark, I didn't get that, but are we going over into Q&A, or will you
Yes, we're
ask
going
the
into Q&A, but I'm kicking off with Monet. So Monet, go for it with you muted. Thank you. And then Alvina, I hand over to you.
Thank you so much, Mark. Ladies and gentlemen, I received a question from a lady by the surname of Hendricks. I must just acknowledge that she's no relation, Jan, into, I'm not sure, but maybe she may be a related party through marriage. I'm not sure. We can check that. And the question was, how do I apply for exemption? And you will apply for exemption by lodging an EI1 application form, and that is the same application form that will be used if you'd like to apply for Section 18A status if you're already approved as an exempt institution. The question then goes further to say, how to obtain a PIN? Unfortunately, I'm not very sure, it's not very clear with what is meant with a PIN, but I can mention that we do not issue a PIN if you are approved as an exempt institution, but you do get a very specific exempt institution's reference number, which will be used in addition to your income tax reference number. If you are referring to a tax clearance PIN, then I would like to refer you to the website, as that will indicate how you will get a PIN for your tax affairs in general. I do hope that that assists, and the other questions that are coming up, we will answer them as they go along. Thank you very much. Over to you, Alvina.
Go for it, Alvina.
Thank you, Monet. I will now introduce the additional panelists, which is Jan Kutsia and Akona Tengwa. Thank you for joining. We received a two-in-one question from a tax practitioner, and it reads as follows. In this specific instance, the beneficiaries of a family trust are minor children. The grandfather of the beneficiaries donated 2.5 million rand to the trust. Is this amount subject to Section 7 Cap C? And if not, what are the tax implications thereof? The second question in that question is, we are now aware of the terminology of a dormant company. Further to that, we now understand what the term passive trust means. But can you explain the difference between the two? I will hand this question over to Jan Kutsia and ask him to respond to that. Thank you.
Thank you, Alvino. I was thinking that you're going to answer the questions, but thank you for posing the questions. Yeah, back to the first question, the 7C donation by the granddad to a trust with minor beneficiaries. Is 7 Cap C available, applicable or not? If you look at the requirements of 7C, Alvino, it says that it will apply to any loan, advance, or credit made by a connected person to the trust. Now, obviously, the granddad will be within the definition of a relative, but the question that needs to be answered is the donation, will that qualify as a loan, advance, or credit? Now, if you look at what a donation is, and there are various court cases, and the silver line through all of them is there must be a gratuitous disposal of a benevolent nature for a donation to take effect. So there's no in exchange receipt of money's worth. So in this instance, the donation to the trust will not be subject to 7C. However, there may be tax consequences for the granddad. And without being too technical about it, it all depends what the trust deed has to say. And the section that I'm thinking of is an anti-avoidance provision contained in section 7.5 of the Income Tax Act. But back to the original question, no, there won't be any 7C issues. However, a further tax that is potentially payable is donations tax in the hands of the donor, granddad in this case. The amount of 2.5 million rand exceeds the exempt portion of 100,000 rand per annum. So on the 2.4 million rand, 20% will have to be paid in the form of donations tax. Now the question, Alvino, is who's liable for this? Is it the granddad? Is it the trust? And if you look at the relevant sections contained in the Income Tax Act, it's the granddad and the trust. If the granddad doesn't pay the tax within the prescribed period, and when I did my presentation on 7C, it's within the month, then the trust becomes jointly and severally liable for the payment of the tax. So no deemed donation in terms of 7C. It's a physical, actual donation, and donations tax will be paid. Right. The next question is very interesting, Alvino, because going through these questions, as Mark said, there's a line in terms of donations, but there's also a line in terms of what is a passive trust and what is a dormant trust, because it seems to be there could be confusion. I think there's also a question in terms of my trust has got a primary residence, and that's it. There's no economic activity, if you will, in that trust. Now, is it a passive or is it a dormant trust? Akin to a company, there is no technical definition of a dormant trust. And why do I say that? If you look at the terms and conditions of the trust deed, the trustees are subject to obviously what the trust deed has to say. And if the trust deed says that the trustees must convene at least once a year to discuss the matters of the trust. Remember, a trust is governed by the law of contract. So the donor and the trustees, they enter into an agreement with each other that these are the terms and conditions which they will abide to, the trustees. So they will have to meet once a year. It sounds absurd, but that's what the contract says. They've got to meet once a year. They've got to discuss. That there are certain issues and obligations on them that they must attend to. Now, Alvino, a very important point is, what does Section 10 of the Trust Property Control Act have to say? Now, Section 10 of the Trust Property Control Act says that where trustees come into money, they must deposit the money into a bank account. Well, it still refers to a building institution, but I don't have the building institutions anymore. But the point is that the trustees are under obligation to, right, that's an issue there. A second very important issue, there's also an obligation on the trustees to at a certain date, and it's normally end of Feb, like today, to make sure that the financials of the trusts are drafted. So it may sound absurd, but that's what the trust deed says. So if the trust is going to lie in your top drawer, you're not going to use it. Rather, deregister at the Master of the High Court and get rid of it, because there are obligations. Now, back to our notice that Nozuku referred to earlier. Sorry, Alvina, I see we've got 3 minutes left, and I want to move on quickly.
Thank you.
In terms of the notice that the Commissioner issues each year, that trust must register for tax. Whether it's got zero assets, it is supposed to. So that's why SARS's legal team decided to use the term passive trust, meaning a trust that's got no economic activity, a trust that's got zero assets, a trust that's got zero liabilities. That's a passive trust. And there will be, I don't know whether my colleagues presented earlier, but there will be a shortened form, R12T, that will be submitted, a shortened form for passive trust. Alvina, I hope I answered the question, the difference between a dormant and a passive trust. So a trust that holds fixed property technically is not a passive trust because it's got assets.
Yes.
I'm going to hand over back to you, Alvina. Thank you for the question.
Thank you, Jan. Thank you, Jan, and thank you, Akona, for being available as well. But unfortunately, we've reached the end of our Q&A. Mr. Program Director, I will now hand over to you. Thank you.
Well, thank you very much, Alvino, and to the panel. Unfortunately, we have not got through all the questions. I saw questions about collective investment schemes as well, and there's quite a few others that we are taking note of, and we hope that we can provide further clarity. But let me conclude firstly by thanking you for attending primary, and secondly, to the people who have presented here this evening. And I trust that it's been informative and that you've gathered some information tonight. I know there's lots of things that haven't been addressed yet, but we'll get there and we'll address that. A reminder that there's SARS TV that's available on YouTube. We also have a Twitter handle, or as X handle as such now, and LinkedIn and Facebook. And just again, in conclusion, a reminder of the survey that we'd like you to do. And with that, I'm going to conclude with grateful thanks to you, and also to Eula, the interpreter, for doing that tonight. We do appreciate that. Thank you.
Fellow South Africans, I'm addressing you this evening.
All your years of paying tax, you helped us overcome our darkest hour. You, along with every other loyal taxpayer, helped build this nation. Thank you for every life you saved and for every risk you braved, for giving our future generation a healthy start. When you saw many of our vulnerable communities, you provided for them. When you saw our healthcare workers on the front lines battling COVID, you rose to the occasion and gave them the tools to save lives. Without your tax compliance, we wouldn't be able to fight a good fight. Thank you for contributing to the important services our vulnerable communities rely on every day. To all taxpayers and traders, continue to pay your tax because it matters to millions of South Africans who depend on it. Your tax matters.